what the India Volatility Index is doing, India VIX, that is down about 7%. Now today the correlation has clearly worked out, the negative correlation, that is, the market is up, the India VIX is down. But over the last 2-3 months, you would have seen, the trend has been interesting. On some days, both the VIX and the market are up. On some days, both are down. And really, a lot of traders, a lot of smart traders wanted to know if they could actually trade VIX and make money, like it happens with, say, a CBOE VIX. Now you'll have a new product, come 26, you'll have futures contracts on the India VIX, and what's interesting is that it will not have monthly expiry, it will have weekly expiry, and you'll have 3 simultaneous series which will be running on this particular contract. So what does all this mean? R. Sundararaman, Chief of New Products, ISL and DOTEX now joins in. Sundararaman, hi, good morning. I think this is a product which traders were waiting for long. If you could explain why you have chosen weekly expiries and not the monthly expiry, that is the case with normal derivatives products.
Sure, good morning. As you rightly pointed out, this is a new product. This is on volatility index. India VIX is a volatility index being computed from Nifty option prices by NSE. Across all strikes, whatever bids and asks are expressed by the market participants, from the volatility index is computed. The contract is going to be a weekly contract, and there will be 3 weekly contracts at any point of time that will be available. Why weekly contracts and why not monthly contracts is the question that you are asking. If you look at the option trading in the market, the near month and the next month contracts are typically very active. The third month contract becomes active almost towards the expiry of the first month contract when the rollover starts. Given the volatility profile of the market, given the short-term nature of the volatility profile and the nature of option trading in India, we felt that weekly contracts would be more suitable than monthly contracts. Moreover, there has been a long pending demand from the market to have short-term option contracts in the market, in the equity derivatives as well. Probably when a new product is getting introduced, trying such a requirement from the market participants we thought would be most helpful. That is the reason for having a weekly contract.
Okay, that's interesting. What kind of participation do you expect, Sundararaman, and would you be introducing options as well as we go along, or for now it's only futures?
With regard to the first question as to what type of participation we are expecting, the NVIX, as we call the VIX futures, NVIX is a very versatile product. It helps market participants in hedging their portfolios from unexpected volatilities. It helps option traders to augment their trading strategies, and it also helps people to take view on the volatility. As you observed some time back about the negative correlation and also about the behavior of the VIX, in the sense that when the market expects some volatility in the near future, VIX increases and vice versa. And VIX has a mean reverting capability, which is typically it exhibits repeatedly. Given all this, we feel that all the types of market participants whom we talked about, people who want to take directional views or who want to hedge their portfolios, or option traders, should be finding this product very useful and very versatile, as it is being found in many other exchanges internationally. With regard to the introduction of VIX options, what we feel is that typically whenever a new product is introduced in the market by the market regulator generally starts with the futures market, and once the market starts understanding the product better, options get introduced. If you take index futures, it came first and then came index options. Currency futures came first and then came currency options. So we feel same way, when VIX futures start getting understood by the market well and started getting traded very well, we will be able to request to the regulators to consider introduction of VIX options as well.
Okay. Mr. Sundararaman, what sort of volumes are you expecting on this product? It's especially going into something like the elections, which would be a big event for the markets?
Here again, I split the question into 2 parts. One is the volume part and second is the election part. If you look at the volumes part of it, it's a long felt market need that we have introduced this product. In our interactions with the market participants since the issuance of our circular, the response from the market has been extremely supportive and good and very encouraging. How much it will translate into exact volumes, that will be very difficult to predict. What I can share with you as an experience with regard to volumes in respect of any new product is like this. When we introduce a new product, on the first day, second day and the first week, you find extremely high levels of volumes, because all the market participants would like to trade this product and see how it works. The novelty attracts more participants. After that, the market sort of stabilizes and the members start stabilizing their systems based on the experience that they have gained. And then there becomes a consistent growth in the volumes. The growth also is dependent on various augmenting factors. In this case, some of those factors would be introduction of VIX options, having ETFs on VIX, and all those stuff. That is first part of the question's reply. The second part with regard to the elections. Event-specific volatility spike is known everywhere in the market, throughout the world. How much that spike would be and how much it will translate into trading activity depends on market perception on the impact that may arise out of such events. What's the important point that we need to note here is NVIX, which is the futures on India VIX, is going to be such a versatile product that will help members hedge their portfolio in respect of any volatility, whether it is arising out of specific events or not.
Sure. Sundararaman, two-part question, and this is the last question from my end really. One, what would be the cost structure of this product to begin with? And secondly, do you expect a lot of volumes or some volumes to shift from options trading, Nifty options, to India VIX? A lot of traders now take option positions, straddles or strangles, based on volatility, while they may not be certain about the market direction. Do you expect that kind of shift from Nifty options to India VIX futures?
Okay, with regard to the cost structure of the product, this will not be in any way different from what the futures product today trading on NSE attracts as the cost structure. The product has been defined in such a fashion that with a 2-tick spread on a round-trip transaction, the entire cost to the market participant is covered, so that at any point of time it becomes easier for somebody to trade this product. With regard to comparison between India NVIX, which is the futures on India VIX, and trading straddles and strangles to take a view on the volatility, if we were to compare these two, if you look at any trading in straddles and strangles, if somebody wants to adjust their position, they need to do delta, gamma and vega hedging all together. Apart from that, there will be certainly a theta decay which will be happening in respect of options. If you look at NVIX, it is versatile and it does not suffer from the gamma factor, and therefore to that extent becomes more useful. Will the volume shift from from options to NVIX? I don't think so. Actually, it will augment. Any option portfolio is left with a vega risk. So today here is a product which is going to help people in hedging their vega risk. So I feel it will actually augment option trading and will become part of option trading strategy, and thus therefore augment volumes as well.
Okay, Mr. Sundararaman, thanks very much for joining in.